tell maybe? Or?
Okay. Hi everyone, I'm David May. I'm from Jersey and I work for Credentials. Checking out a few for today.
My name is Ray Samuels. I'm living in New York and I work for Credit Suisse. And I'm down enjoying the great weather and seeing some.
Currently in Denver. Was in Boston for about 3 years.
Okay. Administrative stuff. Your exams are graded, and they'll be in your lockers this afternoon. I don't hand them out in class. Usually it's a mess, free for all. It's not worth it. And I'll talk about the exam, I guess, next lecture in more detail. It did have fairly high variance. Some people did unbelievably well, and then some people didn't do so well. And which I guess is usually like a negative. High variance you don't necessarily like, but in this case, remember there's this option component. You get to potentially drop the midterm exam. So we know that with higher variance, what happens to value of the option? More volatility here. So the option turns out is going to be very valuable.
You know what the average was?
I'll go through all that next class. So. Okay, and let's see what else. Also, assignment 1 will be handed back today. The other thing is that assignment 2B is due the Monday, like next Monday. And some people said, well, that's really cruel because we're away and blah, blah, blah. It seems that a strategy that's possible for anybody, and I shouldn't even have to suggest this, is to trade out of your options beforehand. Right? Just liquidate, sell, buy, whatever you have to do. And if you want to do that on Wednesday's prices, that's fine. Or Wednesday or Tuesday's prices, that's okay. Just think the treasurers will return for the last part. And so, yeah, it's due, but you don't need to hold until the last possible day. It's up to you. You're in the investment. Now, I said that I didn't want people holding bills the whole time. But as long as you're in for a while, you can do this. The other thing is that 3A is due today, and some people emailed me trades. Some people emailed me this box position. I do need the box. Okay, so if you just email me the trades, that's fine. You're in, you know, that's okay. But at some point, I do need what all the details of what you're doing. Okay. For those of you that emailed just the trades, at some point, it doesn't have to be today. Just get me the rest of it.
We just give you this box today, and this will just be our trade-in.
That's fine. Yeah, that's what does people look at. Okay.
Email you a spreadsheet.
Yeah, most people email me a little spreadsheet. Say again? Yes, they email me on Friday, you're in. Okay? It doesn't matter if you spend the box or a trade, you're in. So, anybody up more than 250,000?
Yeah, more.
Still? Nobody? And anybody up more than 250,000? No? Down more. Yeah, very conservative. Somebody asked what I would have done. Silence. Well, I won't tell you particular commodities I would have bet on, but probably the maximum possible leverage the most out of the money options. And actually, I've seen in previous years, people actually got together on this and asked me beforehand whether it's a violation of the honor code. Nothing on this assignment is a violation of the honor code. But one person taking just a massively short position, so put options, way out of the money, trading for the smallest possible amount, the maximum exposure. Then the other person calls, way out of the money, maximum possible exposure. And so if anything happens in the market, one person is going to make a huge amount of money, and the other person is going to lose everything. And then just like split the proceeds of the game, right? All the cash that we put in, visitors get to pay for this assignment. That strategy will work if there's any volatility in the market. If there's no volatility, then both people lose, right? So probably that's what I would have done, given that I kind of knew like all the details. Most of you didn't know the details before you started, right? Which is fine. And you just kind of follow what you're following, right? And you learn something from doing it.
Still weak or so.
Yeah, there is, right? There's some limit positions here too. So you can do some trading if you want, but that's probably what I would have done. But you had to recognize if you did what I was suggesting, that you're taking great risk. Right? It's a position that you would not hold if you were actually doing this for real, unless it was just a desperate gamble. Yes.
For the futures positions, I mean, the objective in futures isn't always just make money. I mean, you're trying to eliminate risk. So I mean, you can have two objectives.
Say it again. You're trying to eliminate what?
Risk.
Oh, sure.
So
Like
I mean,
options too, right? The objective, like if you had an objective, I'm going to hedge this, or I want to provide, a floor. That's perfectly valid.
Right. So we don't have to try to maximize profit on that.
Absolutely not. It's very clear in the assignment that you don't get rewarded for that, right? But I'm just saying that, well, if I had a choice between putting a hedge position up or doing something else, I'd probably go for the money. Personally, if somebody asked me, well, I would have done it. But I'm not saying that you shouldn't have put a hedge position on, because you're going to learn something from that, right? You do buy the stock or buy put options. You're going to see it. The stock goes down, the put option's going to kick in. That's great. You're not going to take the cash for it, but you're going to learn something, which is more important. Okay, any other, is that clear about the date confusion? Yeah. Okay, let's see, what else? Let me, just before we begin the lecture, there's some confusion on the sort of textbook hedging examples from last time. And the way that they were framed was a little confusing. And let's go through that very last example. So if I recollect this example, it's a situation where you're expecting to get $5 million, and you're concerned about rates going down. The current rates were 10.5%, if I recollect the numbers. And you're going to get this money in 3 months, $5 million. You basically want to lock in the high rate. So your risk here is if interest rates go down or prices go up. That's the bad. I always identify the bad scenario first. Rates go up, prices go down is a good scenario, and rates go down, prices go up. That's the bad scenario. So we need to identify. So that's step one. Identify the bad scenario. Step two. Identify the sort of position in the futures market that you need to take to pay off in the bad scenario. The bad scenario is prices going up. A payoff in the futures market that is going to compensate for that is prices going up. So it's going to be a long position in the futures market. Now, if you recollect the details of that actual transaction, what the person did is went long 50 contracts, 50 times 100,000. Is $5 million. And at the time, the price of the Treasury bond was 76. And really, there's three things that go on. There's three actual transactions. So let's just list them. And there was like cash and futures. And so transaction number one is long 50 contracts of T-bond. Okay. And the settlement price is $76 for $100. Approximately. Okay, there's no money going out here. Just take a position long in the futures. The $76 doesn't go out, and nor that multiplied up to 50 contracts. Okay, you're going to benefit as the price changes. And we're going long. If the price goes up, if those settles go up, then money is going to be transferred into our account. And then we assume, basically, that nothing happens. And to simplify this, nothing happens, and then transaction number two is reverse out by taking a short position to cancel out the long, and the settle was 80. And that's the good scenario for us in terms of the futures. The price goes up, we're going to profit. Right? And the third thing is we actually invest our money. And refresh my memory, it was like we invested at 9.5%, we started at 10.25, is that correct?
Yes.
Right. Yeah, okay. Invested 9.5%. Okay. And what we're concerned with was falling rates. Well, the rates did fall. And we lost 0.75% per year, and assume the same number of years as the Treasury bond. We could calculate what that was worth per year, $37,500. And the present value, what did that equal? 350,000 or something? Or 300,000?
315.
315. Okay. Okay, so we kind of lose that opportunity. That's how much extra we would have made in present value terms if we could have invested at 10.25%. And then we go over to the futures, and basically we get the difference here, which is, if we do it in terms of $1 rather than $100, it's going to be 0.80 minus 0.76 times 100,000 times 50. And that means that money is transferred into our account equaling whatever that is. What was it?
4 million. So it's 680. Sorry, I'm looking at the wrong one.
Okay. What was the number exactly in the example? I forget. 184? 184. So plus 184. Okay, so we get this one-time gain, 184,000. We take a loss of 315,000 in terms of that opportunity lost. Okay. So the correct way to do this, and what I mentioned right at the end of the lecture, was that the problem in setting up this hedge was that we've got $5 million to invest, and you went long in the futures $3.8 million. Because the value of the bond is 76. 76 times 50 is 3.8 million. Okay? That the person setting up this hedge in this textbook forgot that the market price can differ, in this case, radically from the par value price. So this hedge was set up on the basis of the face value, the par value of the bond, when actually what we should have done is to set it up on the basis of the actual market value of the bond. So let's go and write this out a little more formally in terms of how to do this hedge. So what we want to do, and this is in the notes somewhere, and I think I've done it before, calculate the dollar loss on cash position. And this is obviously in the bad scenario. In this case, what I would do is to calculate a 1% move in interest rates. Okay, so the dollar loss for a 1% move in rates. In this case, the rates would come down. So we're at 10.25. What happens if we go to 9.25? And that's going to be $5 million times the modified duration of what we intend to invest in. And what we want to do is to match this loss with a gain. So dollar gain in futures per contract times number of contracts. So right here it's going to be whatever the market value of contracts times the modified duration, and I'm going to put underneath this of the futures. Okay, in parentheses, let's say. And we need to know how many, and let's call that big A. So if we do this, suppose the modified duration of both of these is 7%. Okay, I'm just assuming that's the case. So the modified duration of the futures is exactly the same as the modified duration of what I want to invest in, a 20-year bond. And that's going to be 5 million times 0.07 equals 350,000, right? And over here, the market value of the contract is on a $100,000 contract. What is the market value? What is it trading at to settle? 76,000. Change. Okay. Times the modified duration is assumed to be the same. Somebody help me out by multiplying that. $76 times 0.07. 5,320. Say again? 5,320?
Yeah.
So this is also for a 1% move in rates. So rates move down by 1% for each Treasury bond contract. I projected to gain 5,320. Now, obviously, 5,320 does not equal $350,000, right? So you never just do one. The question is, how many do we have to do? And that's where this A comes in. So A is just going to equal 350,000 divided by 5,320. The A, again, help me out, is going to be obviously more than 50. 66, round. This is the correct way to approach the problem. You don't have to go through the opportunity loss, 0.75% per year, and the present value of $37,500 for 20 years equals. You don't have to do any of that. Just figure out what the interest rate sensitivity is, how much you're going to lose if rates go down by 1%. We know by the modified duration that's easy to calculate. Yes?
The modified duration of these instruments would be different. You're gaining risk.
Well, let's do it. Let's do it.
Right. More than 1%.
Let's do it. So suppose that that the bond that you're really interested in investing in has got 7 years to maturity. And suppose the modified duration was 3.5%. Not 7%, 3.5%. Do the calculation. First, do you need more contracts or less? More? Okay, you're more or less. So let's think about this. Okay. So basically, if we calculate the dollar loss for a 1% move in interest rates, given that we start with $5 million, we know the modified duration is 0.035. It means that the dollar loss is going to be $175,000. And we're going to equate that with this same number over here. This remains the same. Right here. Can't see that? So what does the A have to be to get 175,000? 33. So if the modified duration of what we want is 3.5%, that implies A equals 33.
Yeah.
Yes?
Yeah, I think this question was more, what if interest rates moved more than 1%? Is there some sort of risk? And because I think the answer is that because the convexities are different, you do have some sort of, I guess what you refer to as basis risk here. But it's
Absolutely. So in this case, or what we started with, is a case where we've got identical modified duration. That's what we start with, 7 and 7. Okay, and in general, when you do hedging, you'd like to find an instrument that's got as close as possible. The modified duration is what you're after. Okay. Now, we could do an extreme example here. Suppose that you're interested in investing in the Treasury bond, and you calculate what your loss is for a 1% move, 350,000. We could actually calculate the A if we use the Treasury bill for hedging. Okay. So what's the modified duration of the Treasury bill approximately? Yeah, somewhere like 0.25. So we can calculate in the same way, if it's 0.25, and let's say that it's trading at 98. Okay. Multiply 0.25 times 98, and we see kind of the dollar change in that contract for a 1% move in interest rates. So we can do this duration matching. What we did is we changed the modified duration here from 7 to 3.5. We could also change it on the other side for a different contract. Now, the important thing is that you should always choose as close as possible to modified duration. Okay, so you should not go to a futures contract that's got a 0.25 modified duration when what you're interested in is 0.07, and there's something trading that's above 0.72. And this is what could happen. The bad scenario occurs. Let's say we're hedging with the Treasury bill. The bad scenario occurs, which means that the longer-term interest rate goes from 10.25 to 9.5. And we lose some money as a result. It could be on the Treasury bill side that the interest rate goes up. So the longer term interest rate could go down. The shorter term interest rate could go up. That's quite possible. Now what happens there? So we're losing on our bond. And what happens in the futures? We're losing on the futures. We're losing on both sides. Not a very good hedge. Okay, so that's an extreme example where you're really mismatching. Now technically, if you go by the formula, it's okay. You know, the formula says just match the dollar gains and losses for a 1% move. But it's very important to realize that this is an approximation, and the quality of the approximation is going to be enhanced if the hedging instrument looks very much like what you're going to invest in. And remember, we're using modified duration. Modified duration is only an approximation. So even if we had the situation where we're thinking of investing in the 7-year bond and we're hedging with the 20-year bond, that there could be a situation where rates move a lot and the modified duration is no longer that great of an approximation. Okay? And the idea there is that the convexity could come into play, which is kind of the error in our approximation. So if we've got different instruments with different modified duration, different convexities, then these hedges are not going to be perfect. They're only going to be approximate. And if a lot of money's on the line, you might want to really seriously worry about these higher things like convexity. That's exactly what you do in the money and capital markets course next fall. Worry about convexity a lot. And basically, you fine-tune what we did in this course. Okay, so is that clear or more complicated? That's basically what's happening with that example.
Which instrument would be more convex, more on bond or the option of bond? If they had the same modified duration, they'd be the same for a change, a large change?
Yeah, basically the same. Yeah, it's the underlying asset. That's what we're going to care about.
But it just can't do the perfect matching. That's what
That's right. So we can't do the perfect matching. And it's fun, I'll just tell you that suppose that you do have a 7-year bond, and you're faced with only 2 possibilities in the futures, the Treasury bill and the 20-year bond. Well, it's possible you might invest in both of them in the futures. And the second year course shows you how to do that. So you take a small position in both, and the weighted average duration is the same. The other possibility is that there is a futures contract on something that's got shorter duration. So you might consider that.
So if they pension funds running this all the time when they get interest rates and that we're having challenges.
Well, they know what the modified duration is. And let me guarantee that they know also the convexity of what they've got. Yes?
I'm a little confused on the last sentence on that example that you just went over. When the person doing the hedging confused principal value with market value. I need some clarification on that.
Yeah. What is the value of, to calculate, right up here in the corner, to calculate the dollar gain in the futures contract for 1% move in rates? How do you do that? That's the question. So I give you the modified duration is 0.07. How do you do that calculation? And it turns out that the price of the bond in the futures is 76. The modified duration is 0.07. To calculate the approximate gain in the futures is 76 times 0.07. Works out to 5,320. That's what you do. Now, what they did in this example is to say, well, the price is not 76, the price is 100. So in that case, based on 100, it would say that it's not 5,320, it's 7,000. But it doesn't mean anything, because the price is 76, not 100. So we always use the market value of the bond, not the face value or the par value of the bond. Does that help?
Yes, thanks.
Yes.
Going back to the example like where you were a bank and you were going to issue a 3-month CD in 3 months, and you're trying to find an instrument to hedge with. I'm a little confused as to which instrument you're going to hedge with. Say you choose $0. Okay, are you going to choose $0 that mature, like a 3-month $0 CD that matures in 3 months, or one that starts in 3 months and then matures in 6 months?
Okay, so
You know
that's a
what I'm
good question. And it's got a number of aspects to it. First, the bank is going to issue 1-year CDs.
Okay, 1-year CD.
And it turns out that there's no 1-year CD contract. The contract that's traded, the $0 contract, is for a 90-day CD.
Right.
Well, remember how that contract works. Okay? So if you agree to go long or buy, let's say I do that today for a March. So I go long the March euro dollar. It's a 90-day contract. Tomorrow, it turns out that there's not like 89 days left. There's 90 days. And it's always 90 days. Because the 3rd week of March, I could potentially get physical delivery of a certificate of deposit that's got 90 days to go. So the actual period whereby the interest is paid after I take delivery is like from March to June.
Okay.
So like our treasury bills, maybe a better example because you actually can take delivery of the treasury bill. So if I agree to buy a treasury bill in the 3rd week in March, you know, the price is going up and down and money's being transferred in and out of my account. But if I actually take the delivery of the treasury bill, and it's a lot easier to take delivery of the treasury bill than like pork bellies or hops, right? Piece of paper. Okay? It means the 3rd week in March, okay, I'm going to buy this treasury bill at the fixed price. And it starts the 3rd week in March, 90 days to go. And after that, you know, like after I take delivery, it's going to be 89 and 88 and 87 all the way through to the end. Okay, so it begins once you take delivery. But in the futures, as you're going day by day, it's the same maturity of the underlying asset.
So then if you're going to be issuing the CDs in 3 months, then you want to take, you want to hedge with an instrument that you take delivery in 3 months as well. Yeah,
so ideally, what you want is a 1-year CD in 3 months. If that was traded, that would be great.
But you can't get it, so you get 4 or 3 months.
Exactly. So, and you use the exact same formula here. It's a loss on the cash position in the bad scenario. Well, it's a 1-year CD. If rate is $100 million, right? So if rates go up by 1%, that means I lose $1 million, right? Because the modified duration is 1, approximately. And over here, the gain in the futures, if I'm shorting the futures, well, if I did the exact naive sort of match of $100 million, then the gain is $250,000. So for each contract is $250,000. $250,000 doesn't equal like $1 million.
So you're just trying, I mean, back to my original question, sorry, you're trying to take, match the delivery of the asset that you're hedging for with the delivery of your hedge.
That will tend to equate the,
That'll help.
yeah,
Okay.
that's going to help.
Makes sense.
It avoids rolling things over. There's other ways to do it. Well, I'm not saying it's the only way to do it, but it's the simplest way to do it. Remember, this is supposed to only be the introduction to hedging. Right? The derivatives course goes into this much more detail also. Money and capital markets and derivatives. But this gives you enough to know basically what's going on. Because it's a very important thing, in my opinion. It has some knowledge. You see it all the time in the Wall Street Journal, people doing things that they thought they were hedging when they weren't hedging. Taking losses, big losses. Okay, well that's what I wanted to review. Next, let's talk about portfolio control. motivate. Well, there's copies of the lecture note at the back.
Shish, I'm all over it.
Yes, modified duration plus convexity. You can do it. Yeah, it's real easy to put in. Very similar system. Another column in this spreadsheet. Okay, let me try to motivate what we're. This is usually like the first lecture in a finance course, from my experience. Okay, the basics of portfolio theory. I've done it differently, as I said, because I wanted to talk about the individual assets before we put them together. But one of the things that we're after is a way to evaluate an advertisement like the following, where the Franklin Income Fund, a mutual fund, shows that over the last 15 years it had 516% return. And some benchmarks are the Dow Jones at 384 and the Solomon High Grade Bond Index, the Corporate High Grade Bond Index, 273, and CPI 169. Basically what they're saying is we, over that period, beat the market, invest with us. So it's a number of issues with this type of advertising. It's, factual, no problem with it. But if I'm actually going to put my money with the Franklin Income Fund, I'm kind of interested in, well, not just the past 15 years, but what are they going to do in the future? So I'm more interested in a forward-looking sort of projection. And another obvious question is, what is the risk of their strategy? It's true they've had higher expected returns, but is that because they're a riskier portfolio than, let's say, the Dow Jones, which is 30 of the safest stocks in the market? So I need to know something about risk, and that's going to help me evaluate. One of the goals is to actually evaluate the performance of this particular mutual fund. Now, to get there, we've got some mechanics that we have to go through. So that's what I want to do today, is to go through some of the portfolio mechanics. It's one of the more mathematically oriented lectures. However, I've tried to supplement it with a lot of examples. Okay? And you'll see that we're going to do some simple examples and some more complicated examples. Also, you notice in this lecture note, there's a lot of material that I consider supplementary, like the investor's planning problem, something you've probably seen from your microeconomics course. And let me scroll through a lot of it and maybe down to this, which is just a graph of risk aversion. And we're going to assume that people are risk averse. And all that means is that in this graph, that you prefer $50 per share to a gamble that delivers 0 or 100 with 50% probability for each side. So you get more utility out of the for sure scenario. Okay, I'm going to assume that people are risk averse. There's also the possibility that people are risk neutral, where you can be indifferent between the gamble. The coin $50 for sure. There's also the possibility that people are risk loving, which means that you would take the gamble, which means basically that there's something else going on, that you really like the risk for some reason. And people, try all these counterexamples that people invest in these very unusual gambles, like going to the horse track. It's like evidence of risk loving. But for me, I just explained that there's something else in this person's utility function. That you get something else by going to the track, some sort of enjoyment, that makes the whole thing consistent with risk aversion. Usually, you work with these really simplistic utility functions, and you know that utility is more complicated than the utility function that you see in macroeconomics. Nevertheless, what you see in macroeconomics is useful for us because it provides us with a framework, risk aversion. And I think that the sharpest evidence of risk aversion is just that over the very long haul, treasury bills have a low return and equities have a high return. If people were risk neutral, you would see that the returns on bills and stocks are about the same. And people are not. So therefore, to get people into the equity market, we have to offer something extra. We have to offer a premium to get them into the market. Sometimes that's called the risk premium. And the risk premium is simply the difference between kind of the equity return and something that's riskless, like a treasury bill, or something that's very low risk. So I think, personally, that it's kind of like a no-brainer that there's risk aversion out there. So a lot of people in my business go to great lengths to try to rebut the idea. I just don't see it. I don't believe the research. So I think that we can use that as an operating assumption, risk aversion. Often there's a whole lecture spent on this. And actually, in previous years, I have spent more time on this. I actually even created once I did this, where I did the gamble, or offered the gamble to students, $50 for sure, 0 and 100. And it was a disaster because everybody wanted me to flip the coin to see me lose $100. And I did. So I'm just going to assume that you prefer $50 for sure. And you can actually go through and derive all of this in terms of utility functions as to what the premium is going to be. And let me scroll to the most important part. The premium, or the risk premium, is actually going to be related to, if we think of this in terms of the market as a whole, so let's call this the risk premium on the equity market rather than the insurance premium. It's going to be related to the variance, and it's going to be related to risk aversion. So the more risk-averse people are, okay, so think of the weighted average risk aversion in the economy. The more risk-averse people are, the higher the premium is going to have to be to get you to invest in the stock market. So we know the stock market's got fairly high variance to a treasury bill. So to get people into the market, you have to offer something else. And something else is this premium. It's very much linked to the variance and to the risk aversion. And actually what some people do is they look at the excess return of the stock market over the treasury bill. And given that they can estimate the variance or the volatility, you can kind of back out what aggregate risk aversion is in the economy. And that's kind of an interesting exercise. Well, yeah, I've actually done that. So I think it's interesting. Mainly, the reason I found it interesting was that I was interested in doing it for different countries to see if I could detect whether people in Japan are more risk averse than people in the U.S. So I thought that was an interesting question. But it's kind of... Say again?
Where'd you find out?
Oh, you want the results. Well, the results are complicated by a number of things. I don't want to hedge too much, but one thing is that I believe that the local Japanese investor, up to a certain point in time, and the reason that this is complicated is that you really need to look at it like a closed market. If there's international investors coming in, that could mess this up. And the Japanese market for a long time was kind of a closed market. And within that time, the risk aversion was much higher than the U.S. And you can see that just by the way they allocate their investments. So the Japanese investors got a much larger proportion of wealth in very low risk assets, like treasury bills and what they call postal savings. So I saw almost immediately a difference in risk aversion. And I was actually trying to use this to account for the run-up in the Japanese market during the 80s. That I thought that, well, to get people into the market, you have to offer these high returns, and some of them are being realized. And as soon as they opened the market up, it seemed that the market crashed. So I was interested in a lot of things, but that's kind of a sketch of the results.
Can you apply that to the emerging markets, or is there too much international investment already?
It depends on the market. You know, there's some markets that are effectively closed, you know, like Japan was, and you can apply this idea directly. And then there's some markets that are open, you can't apply this idea directly. The risk aversion you're going to get is kind of a world investor risk aversion. So I do that too. And what I find is if you apply the two scenarios, they don't work. But there is a scenario with an emerging market becoming more and more integrated into the world. And you can actually parameterize that and back out how the local risk aversion is changing with your time. And I've done that. So that's very interesting. So it turns out the risk aversion is very high in some of these markets. Okay. Small aside. Okay, what about portfolio selection? And here's where some of the mathematics come in. I'm going to try a different approach than what's pitched in the lecture note on the web, so that I don't lose anybody on this. And I need to use some matrix algebra for this. And you probably, my experience is that people have forgotten a lot of that stuff. Okay? But my experience also is that people use this matrix language called Excel. So that's all it is a matrix, right? So if I can relate some of what I'm doing here to Excel, then maybe that's going to help. Okay, so the first thing is to calculate the return on a portfolio. And let's say it's the weights, the transpose of the weights times the returns on the individual assets. Well, what do I mean by that? Well, if we think of a spreadsheet, we could think of it as having column A, which are basically the names of the stocks, like IBM, DEC, whatever. Let's say we've got 100 different possible stocks we're going to invest in. And column B is the returns, are the returns. 0.05, negative 0.07, great, 0.25, whatever. Okay, 100 different stocks. And then C are going to be the investment weights. How much of my portfolio do I put in IBM? How much do I put in DEC? To simplify this, let's suppose that equal weights are assigned. 0.01 to everything. Now, how do I calculate the portfolio expected return? So RP, that I call it, is just going to be, and excuse my Excel, I don't really use it. I think this is correct. B1 to B100, and that's going to be multiplied by C1 to C100. Then multiply the two columns, B and C. Sum product, same thing. This will work too, right? So we want to create, we could create D equals, what is it, sum prod? Is that it? Something like that? So D, all D is going to be B times C. Okay? And then we're going to sum B. And that's what the sum product command does. It takes the product of two columns and sums it. And that's it.
What's RP?
RP is the return on the portfolio. Portfolio return. Yes?
And the weight is just the dollars not invested divided by the total value of the portfolio.
So I've got $1 million 1% of $1 million is $10,000 invested in one year. So I guess I should say that this is RP also, the sum problem, right? Okay, so it's a simple matrix command, and that's basically the same thing as what I would write as W prime times R. So W being a transpose. So what this does is it multiplies something that's got one row times 100 columns times something that's got 100 rows times one column. So row times column and row times column. Again, same thing. Okay? And there's an alternative way to do this in Excel using the matrix command. And you know how to get a transpose of a column. Remember, a transpose of the column turns it into a row. So I could turn the weight column, which is C, into a row, and then use the matrix multiply command in Excel. When I multiply times B, then I'm going to get exactly the same answers as sum product. So one of the important things in this lecture is for you to actually go out and play with this. Not with a 100 number, it's something smaller. Make it more manageable. To see that you can do all of this stuff real simple. The other thing that I say in the lecture notes is that the sum of the weights, and I denote that is W prime times 1. And 1 is just a column of ones. So if I multiply the transpose of W times 1, I'm going to get 1. And this is just the same thing as, I guess, sum of W1 to W100. So the sum of the weights equals 1. Must equal 1. Always. Okay. The next thing is expected returns. And these are the actual returns that were realized. We might have like target or forecasted returns. And that's just a matter of just changing things, changing column B to the target returns, or the forecasted returns. Same operation. And it might also be the case that we're interested in excess returns. And excess returns are simply the returns minus some risk-free investment. Let's say the Treasury bill. So during this time, the Treasury bill return might be 1%. So take column B, subtract the Treasury bill at 0.01, and we get a new column, 0.05 minus 0.08 minus 0.26, ... There's many different ways to do it, but it's basically the same command. So we can get expected excess returns, we can get actual excess returns, we can get the target returns themselves. All of this are fairly simple operations. Okay, the next thing is the portfolio variance. Okay, and the portfolio variance is going to be denoted V underscore P for the variance of the portfolio. And that looks a little more complicated. It's W prime V times W. And let me detail what this V actually is. Okay? The V is the so-called variance, covariance matrix. Okay? And an example of V, let's say we have two assets, and it looks like this. And the same thing is sometimes written like this. Okay. What are these things? The diagonal are variances. So this is the variance of asset 1. This is the variance of asset 2. The off diagonal are covariances. This is the covariance between 1 and 2, and the covariance of 2 and 1. It turns out that sigma 1, 2 equals sigma 2, 1. Covariance of 1 and 2 is identical to the covariance of 2 and 1. So this is the matrix that we're actually going to work with. And Excel also will deliver the variances and the covariances. So it's just a matter of multiplying these matrices to get the portfolio variance. Now, in the lecture...
I'm sorry.
Yeah.
That part, what are each of the components representing?
Sure. The diagonal elements are the variances. The variance of 1, the variance of 2, sometimes denoted sigma squared for variance. And the off diagonals are covariances. And this is the covariance between 1 and 2, and 2 and 1. It's a symmetric matrix, which means that everything above the diagonal equals everything below the diagonal. So it's like a mirror image along the diagonal. Yes?
Sorry, I'm missing this. Can you circle it?
Yeah.
Circle.
Has circle variance and vertical columns in this too?
So this is the variance, and you can do colors. That's the colors.
And just the sequence of numbers underneath, like it says 1, then 2, that's from year 1 to year 2.
No, these are two assets, asset 1 and asset 2. There's two assets, IBM and DEC. IBM's got a volatility, sigma squared 1. And DEC's got a volatility, sigma squared 2.
Must be the covariance.
And then there's a covariance between 1 and 2. Yes?
And if you have more than 2 assets, would it just be like along the diagonal you would have the variance of the individual asset, and then the covariances would be the covariance between like the second asset, the first asset, the third asset, and the second asset?
Let's do it. Sigma 2, 1, sigma 2, 2, 3, 1, 3, 2.
You want 1, 3 in the upper right?
1, 3.
Second one. That one. 2, 3.
And everything else is okay. That's good. Okay, so again, not a very well drawn diagonal, but yeah, you can expand it, and you can see that this gets very big very quickly. So along the diagonal are the variances. So now we've got the variance of IBM, the variance of DEC, the variance of Cray. And then we've got the covariance right here, the covariance between IBM and DEC, the covariance between IBM and Cray. Okay. This is the covariance between IBM and DEC, and this is the covariance between DEC and Cray. Yes?
Obviously, with 10 stocks or whatever, we get a whole lot of covariances.
Right.
I mean, people must use historical data for 95% of that and not have all kinds of stuff.
Well, technically, use what your best forecast is. If it's historical, that's fine. It might not. The second year course, we actually spend the whole lecture in figuring out how to fill that matrix in.
So a lot of this taken up by just using data, you're just comparing yourself to the market.
Yeah, but there's no market here with my example. Yeah. I'm not saying you can't do it that way, but I'm saying that this is more general. And you can get into real trouble doing it the way you're suggesting. So you have to wait. The investment course talks about this too. Yes?
Can you interpret what this is telling me about my portfolio?
Oh yeah, that's the whole idea of the lecture. Very
Should I have
important.
gotten it yet, or am
No,
I-
not yet. No. So far, we're just doing, the mathematical notation. Okay, we have to do lots of examples, and you're going to have to do some examples to prove that this makes some sense. Okay, so I'm just telling you what the formula is for the variance of the portfolio. That's all. Yes?
What did you say, that everything above the diagonal is equal to everything below the diagonal?
Yeah, so it's like, if I do some more circling here, so this one equals this one equals this one, and do you have another symbol is a triangle, I guess. Is that one?
It says, so is
Just the way
that
it
so
works.
individually and in sum then, I guess?
Individually, yes. In sum, I guess so. If you summed all the,
Well, yeah.
all the shapes, you get the same on both sides. Okay. The very last formula before we do some examples is, so the variance of the portfolio RP for a set of weights W equals W prime V times W. And if I had two particular sets of weights that I'm interested in looking at, WA and WB.
So it's VP equal RP?
Oh, sorry, VB. Variance of the portfolio. The expected return of the portfolio is W prime times the return of the portfolio times R.
That's when the weight is W prime. What's the difference between W prime and
W is our column, what do we call it? Column number C, the weights. Okay, so it's got 100 rows in one column, and W prime has got 1 row and 100 columns. It's just the transpose.
Another way of writing, I wanted to see if this is true, another way of writing W prime times R is like W1 times R1 plus W2 times R2.
Absolutely. Yeah, that's what it actually equals. Sure. So if you wanted to do it that way, we could write it, and what some people do is to write it as the sum WI RI, I going 1 to 100.
So the variance is then W squared times the weight squared plus the weight.
Not exactly. Okay, we're going to have to see. We're going to have to do an example to see how this actually works. Okay, so the most common example is the formula for 2 assets. And let's just write that one out. This one you should, maybe you've seen before, maybe not. So this is the variance of the portfolio of 2 assets, asset 1 and asset 2. It equals W, and this is basically, we've got an investment in asset 1, which I'm going to call W1, investment in asset 2, which I'll call W2. So the formula for the variance is W1 squared times sigma 1 squared plus W2 squared times sigma 2 squared plus twice W1, W2 times the covariance between 1 and 2, which I denoted as sigma 1, 2.
Isn't it minus?
No. So that's the formula. Now, if you actually go work out the matrix operation, that's exactly what you get. Okay. It's not as important to work it out, but to see that this is what you get.
That means the covariance between the 1 and 2 for the 2 assets you have?
That's correct.
Okay.
Now, sometimes we write this in terms of correlation. Now, the correlation between 1 and 2 equals the covariance between 1 and 2 divided by the standard deviation of 1 times the standard deviation of 2. So I could also write that as sigma 1, 2 times sigma 1, sigma 2. That's important. You should know the correlation and the covariance length. The correlation and the covariance both tell us how these stocks move together. Okay? Positive correlation means that they're moving together. Negative correlation means they're moving against each other. The advantage of the correlation is that it's between -1 and 1. And the disadvantage of the covariance is that it could be anything. -5 trillion, positive 1 billion, whatever. It's hard to interpret the actual number. So that's why often we work in correlation. So we can rewrite the formula as W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus twice W1 W2 times correlation of 1 and 2 times the standard deviation of 1, standard deviation of 2. Okay? So now let's, okay, there's the math, now let's put some numbers to it. See how this actually works. Suppose that I told you, let's see. Suppose that I told you that the variance, so the variance of 1 equals 4, the variance of 2 equals 4. And suppose we're going to consider W1 equals W2 equals 0.5. Notice the sum of the weights is exactly 1. In the last piece of information, the correlation, suppose that it equals 1. Okay, so let's plug into this formula with these numbers and see what the variance of the portfolio is. Okay, so all I'm doing is plugging in to this formula with the asterisk. So it's going to be 0.5, so the variance of the portfolio equals 0.5 squared times 4, first part, plus 0.5 squared times 4, second part, plus 2 times the weight in 1 is 0.5, the weight in 2 is 0.5, the correlation is 1, the standard deviation of 1 is 2, the standard deviation of 2 is 2. And let's work this out. 0.5 squared is 0.25 times 4 is 1, plus 1 is 2. And this mess together is 2. Altogether, we get VP equals 4. So this says that if we have a portfolio with 2 assets with the same variance, and they're perfectly correlated, then the variance of the portfolio is 4. So it doesn't matter if you hold stock number 1 or stock number 2 or the combination, you're going to have a variance of 4. Let's change the example. Let's make the correlation to 0. Okay, so remember, correlation is between -1 and +1. You're going to change it and make it a 0. What's going to happen to the variance of the portfolio? So the only number that's different is this. Right? So we're going to get 2 right here as before. And we put 0 here, it's going to wipe that whole line off. So the variance of the portfolio, so this is with correlation 1 and 2 equals 1. The variance of the portfolio equals 2 with correlation 1 and 2 equals 0. And the variance of the portfolio with correlation equals -1? 0. Does it make sense? Perfect negative correlation. One security is going up, the other is going down. The net effect, 0. Then the first one might go down, the other one's going to go up. The net effect is 0. So if you look at the net effect, there's no variance. Perfect positive correlation, one goes up, the other goes up. One goes down, the other goes down. Down and down. So you have this variance that looks identical to the individual assets. But with negative correlation, or perfect negative correlation, it exactly cancels out. So this is an example of how to use this formula for portfolio variance to show a really important point in finance, that if you combine two stocks that have less than one correlation into a portfolio, there's some benefit. And the benefit has to do with the reduction in the portfolio variance. And here, it was quite dramatic. We moved from 4 to 2 to 0, depending upon our assumptions for correlation. Okay? So this is the first of an example, of a series of examples that we're going to do to show what happens in terms of portfolio variance. Okay. Before we take a break, let's go 3 more minutes. Let me show you on the web. This example is just what we did in class. Notice the examples on the web, I use a V instead of a sigma. It's just hard to get a sigma. They don't support Greek. But it's just the same example. I want, before we take a break, to look at this graph. Describe it to you, make sure you understand it. It uses the same kind of formulas that we've been talking about. And this is a graph out of Fama's textbook, 1976. It's a graph that's reproduced all over the place. This is the strategy. You hurl a dart at the Wall Street Journal. You pick a stock. You calculate that is your portfolio, one stock. And it's got a standard deviation of 11%, and you plot that. That's square. That's one stock. And then you throw another dart, and you've got a second stock. And you create a portfolio with equal weights, 50% in stock 1, 50% in random stock 2. Notice that when you do that, the standard deviation of the portfolio drops. So it's the case that there's almost no chance that these two stocks are perfectly positively correlated. The correlation's less than 1. And because the correlation's less than 1, we reduce the portfolio variance just like we did in this example. We went from 4 to 2. And then this exercise is repeated. Number 3 stock. And again, each stock now gets a 1/3 weight in the portfolio. And Fama continues to throw these darts until you get around 20 or 30 stocks, and it starts to bottom out. So notice that the variance reduction from 30 to 40 is not that important. Okay, so the interesting thing here is that just a random selection of securities is going to reduce the variance of your portfolio. The other interesting thing is that you don't need 500 stocks in your portfolio to achieve this. That it looks like 30 to 40 is fine. So to get a diversified portfolio, you need not seek every single stock in the S&P 500. And actually, people that track the S&P 500 don't invest in the 500 stocks a lot of the time. They have a smaller portfolio. But there's another thing that's pretty important. That this is definitely not the way that you should select stocks. Okay? This just illustrates the mathematical concept that we developed. That when you put stocks with lower correlation than 1 into a portfolio, you're going to get some reduction in variance. And this shows the reduction. It's not going to be the case that we're going to randomly select stocks using darts. And it's not going to be the case that we're going to equally weight every single stock in our portfolio. The whole idea of this exercise is to develop a set of weights. That's what portfolio control actually is. You're going to solve for a set of weights. When you solve for those weights, it tells you what to invest in, and it tells you how much. And it's definitely not going to be any of these portfolios, though this kind of shows the effect of increasing the number of stocks and in terms of the variance of your portfolio. So when we come back from the break, what I need to develop, I'm going to do one more example where we're going to plug some numbers into the formula. It's going to be a real example, not a constructed example, with real data to show you what happens in terms of the formation of the opportunities for us. And then we'll talk about portfolio selection. Okay, so 10 minutes. Let's move on to this example with live data. There's another detailed example where I just put some numbers in and ask some questions like calculate the standard deviation for each asset's return, calculate the correlation between the asset returns, calculate the portfolio variance, calculate the covariance between two portfolios. This is maybe a candidate for you to actually go into Excel and make sure you can verify all of these numbers. Actually, most of the questions you go into Excel for, the only thing you really need is the portfolio variances. You don't want to be working those up by hand. Okay, so this is just a constructed example that you might want to work with. You might want to change the weights to see what happens. But what I want to do right now is to talk about a real example, and I want to talk about efficient portfolios. So, we can calculate a portfolio with a certain set of weights. Like in Excel, in my column C, I've got weights. So I said 0.01. And the dartboard example is 0.01 for 100 stocks. Right? But really what we want is to figure out what the best set of weights are. Okay? And that will deliver an efficient portfolio. So this is kind of the way it works. That if I had 10 different portfolios, and each portfolio is defined by its own set of weights, each of these 10 portfolios have the same variance, which one of the portfolios should I choose? So I'll give you the information. I got 10 portfolios, each with the same level of variance. Which portfolio should I choose? Yeah. Pick the one with the highest return as expected. Okay, now let me change the problem a little bit and say, suppose I've got 10 portfolios, each with the same projected return. Which one should I pick? Great. Okay, so those two very intuitive rules put together will make sure that you land in a portfolio that's efficient. Okay, so you think about it. Think about the problem, like in Excel. And I specified a column of weights. Right? And the weights were 0.01 for each asset. Think of the number of possibilities there. It could be 100% in asset 1 and 0 in the other 99 rows. It could be 100% in asset 2 with 0 in the first row and 0 down for the other 98 rows. It could be, almost an infinite number of combinations of different weights. 0.05, 0.04, whatever. So there's like an infinite number of combinations that we can use to get a portfolio. But if we stick to these two rules, pick the portfolio with the highest expected return for a given level of variance, and pick the portfolio with the lowest variance for a given level of projected return. If we adhere to those rules, then we're going to pick the best possible portfolios. And this portfolio is going to be efficient. So, yes?
But I'm going to make this something, but what if you have portfolios with two different variances and different returns?
Okay, that's what we're about to talk about. We're exactly going to talk about it. Yeah. So if it's the case that things are different, then you have to have a little more machinery. Okay. So let's go to this example, and it's a historical example. And what we're going to do is we're going to look at data, and the data from this article by Bodie and Rosansky called "Risk and Return in Commodity Futures." And the following is the idea of this article. What they were trying to argue is that a diversified portfolio should contain not just stocks, but other things. Like we probably immediately think, well, we should include bonds also in our portfolio. But what they were talking about specifically were commodities, like agricultural commodities, like corn, cattle, whatever, oil, gold, silver, things like that. So what these guys are going to do are going to compare investments in various asset classes. One asset class is just common stock. The other is going to be commodity futures. We're going to use futures to do this because it's easier to transact in the futures market. And it's going to be a portfolio of a number of different futures contracts. We're going to explore that. So the data is all provided here, and let me just go through a little bit of the data. These are wealth relatives, which means that if you invested $1 in common stocks in 1949 and $1 in commodity futures in 1949, what happened? And this column here just tracks the number of commodities that are included in the analysis. And is that a T? Fix that. So you can see how the dollar basically grew. $18 a year, $22 over the futures.
Okay. Is that the market average, or is that 23 best commodities?
No, it's just all the commodities that were available in the futures. Yes.
All the other numbers seem to be off of 49 index of 1, except the commodities index seems to begin with a dash.
Maybe it didn't print. Oh, that's the number of commodities right here. This is 0. So we're just starting at 1. We're actually starting with 10. Okay? 10 contracts.
Is that T supposed to be a 5?
The T, probably. I have to check. Just remember 1959. Because the next thing are the returns. Year-by-year returns. Return is 11% in 1959. But yeah, it's a 5, right? Because he's a 5. So these are just the returns. So the price in 1951 minus the price in 1950 divided by the price in 1950. Percentage return for commodity futures and stocks. What's interesting here? This I think is interesting. 1973. Notice the market takes a negative return, 14.66%, and next year is also worse, minus 26. What's happening here? Oil and recession. Okay. Embargo. See what's happening in commodity futures? What's happening here? Why is this so large and positive? Oil is one of the commodities, and even if oil isn't there, what else is going on? Gold. Gold, and there's just a lot of inflation at this time too, driving up the prices of these other commodities. Notice 75, we got a positive 37% return, and a negative return in the futures. Now, just looking at these three numbers, can you guess what's going to happen when we calculate the correlation? It's probably negative. In this episode, at least, stocks are going down and commodity futures are going up. So there might be some benefit to kind of preempt what's going to happen. There could be some benefit to including the commodity futures in our portfolio. Because in times of negative returns in the stock market, they at least historically appear to have gone up. Not all the time, but some of the time. And these are the annual rates of return on just average returns. So this is common stocks, 13.05% per year on average. Volatility, 18.95. The commodity futures with treasury bills, and what does that mean? It means that we've got 100% money market reserve. Okay, so to calculate the return, just like we did in terms of the last lecture. We've got a percentage gain on the commodity futures, plus we've got our money market reserve making money for us at the Treasury bill rate. The average return is 13.83, volatility 22.43. And some other benchmarks are also given here. Now, is it the case that the commodity futures with Treasury bills is more attractive to us than investing in common stocks? We're going to choose between one or the other. Is it clear cut?
No.
So this is your situation, right? Where we've got a higher expected return, but it's not clear cut because the volatility is higher. So yeah, it's true that we're higher average return with the commodity futures, but the volatility is also higher. So it's not clear cut as to which one we would want to invest in. So let's continue with the data. And there's also real returns that we subtract the Treasury bill. There's excess returns when you subtract the Treasury. Real return actually is subtracting CPI. Excess returns subtracting the Treasury bill. And then the correlation matrix. And it turns out that the correlation between the commodity futures and the common stocks is minus 0.24. Okay, so it is negative, as we guessed. It's not a big negative number, but it is significantly negative. So the last thing that I want to do is to look at portfolios of the common stock and the commodity futures. So we can use the two formulas that we did earlier. So the portfolio expected return is just the weighted average of the expected returns of the two assets, common stocks and commodities. So W1 times the common stocks plus W2 times the commodity futures. And the standard deviation of the portfolio is just that formula where the weight in 1 squared times the variance of 1 plus the weight in 2 squared times the variance of 2 plus twice the weight in 1 times the weight in 2 times the correlation between 1 and 2 times the standard deviation of 1 times the standard deviation of 2. And notice that I've got squiggly brackets and square root around the whole thing because I'm actually going to work with the standard deviation of the portfolio, not the variance. Okay. So I'm going to go, and the data that I'll use is from the summary table. The expected return is 13.05 for stocks and 13.83 for the futures. The volatility is 18.95 and 22.43 for the futures. Correlation is minus 0.24. I also calculated some variances, which is literally just squaring the standard deviation. So I'm going to calculate the expected return and volatility of 6 different portfolios. The first portfolio is 100% in common stocks and 0 in commodity futures. Now, you don't even need to use the formula for this one, right? Because if you're 100% in the common stocks, then the expected return of your portfolio is 13.05. And the volatility of your portfolio is the same as the volatility in the common stocks. It's 18.95. So that's easy, though I went through all of this stuff. Notice there's a 0 here, which wipes out that third term, and a 0 here, which wipes out the second term. Okay. Now, let's shift the weights, and we're going to now invest 80% in equities and 20% in the commodities. See what happens. Well, 0.8 times 13.05 and 0.2 times 13.83 equals 13.21. Notice that the return on the portfolio has gone up. Does that make sense? Yes. Because we're giving more weight to the commodity futures, which has a higher return, 13.83. The volatility of the portfolio, again, just plugging into the formula, 0.8 squared is 0.64, 0.2 squared is 0.04. To work it out, this time we've got to work out the long thing. It equals 0.1474, 14.74%. So notice what's happened here. Portfolio 2 is different than portfolio 1 in that we're adding 20% of our investment in commodity futures. We increase the return by a small amount. And what happens to the variance? Drops. So in this situation, if you've got a choice between portfolio 1 and portfolio 2, which one do you select? 2 is clearly better. It's got a higher return, it's got a lower variance. That's unambiguous. Now let's continue by adding a little more to the commodity futures. So now we're 60% in equities, 40% in commodities. Again, the portfolio expected return increases. And the standard deviation again decreases. So if you're faced with a choice of 3 or 2, it's obvious that you take 3. 3 has a higher return and a lower variance. And it seems like we're kind of on a roll here. Now let's increase the weight to 40-60. Expected return goes up. Volatility goes up also. This kind of makes some intuitive sense that we know that the commodity futures are more volatile. And as we put more and more of our investment in the commodity futures, there's going to be some point where the volatility's got to increase. We know overall the volatility is 22%. We know that 100% of our portfolio in the commodities is going to deliver 22% volatility. So we kind of turn the corner here when we go from 60-40 to 40-60. Now, do you prefer portfolio 4 over portfolio 3? So 4's got a higher expected return. It depends. Okay. That one's not clear because we've got a higher return, but we also have a higher volatility. Then we go to portfolio 5, which is 2080. Still get a higher return, we get a higher volatility. Now we jump up from 13.77% to 17.43. And the very last one is 100% in the commodities, and it's got 13.83 and 22.43 expected return of volatility respectively. Next, the actual returns are given here, different strategies. And I want to actually graph these different portfolios. So this is going to be a graph that you're going to see a lot. Okay, it's called a mean standard deviation frontier, sometimes called a mean variance frontier if we do it in terms of mean and variance. It has the expected returns on the y-axis, the volatility on the x-axis. And all I've done is the red squares are the points that I worked out. So this is 100% equity, 80 equity, 20 commodities, 40, 60, 40, 40, 60, all the way out to 100% commodity futures. Okay? And what I did is I kind of joined the squares with the green curve. And actually, you might want to consider loading this data into a spreadsheet. And all you need to load is the expected returns for the two classes, the volatility in the two classes, and the correlation. 5 numbers. You need not put in the historical data, because if you put it in, that's fine. You're going to get those 5 numbers out of it. Okay. And if you actually wanted to verify this shape, then just try different sets of weights. So this is 100 and 0, and if you go to 95 and 5, you're going to move along this green curve. So you should be able to reproduce this green curve. Okay. Now let's go back to this idea of the efficient portfolios. Suppose that I'm at 16% volatility, and I'm faced with 2 portfolios. One portfolio looks like it's 90% equity and 10% commodity futures, and the other portfolio looks like it's 70% commodity futures, 30% equity. 2 portfolios that I can invest in. Which one do I choose? On top. So it's always the case that if I'm faced with a choice between the top and the bottom, that I choose the top. So it turns out that the positively sloped portion of this curve is called the efficient frontier. And it represents all of the portfolios that we consider investing. Everything along the bottom, we don't care to invest in, or it'd be foolish to invest in. So, what I want you to do is to put those 5 numbers into Excel. Verify this graph. And then I want you to do something else. What I want you to do is to change one of the numbers. I want you to change the correlation. This is drawn for a minus 0.24% correlation. So what I want you to do is to change the correlation and move it between 1 and minus 1. And let me preview what you're going to find. If the correlation is 1, then you're going to find that the frontier is a straight line between these 2 squares. And if you put in a correlation of 0.9, then you're going to deviate from the straight line and get a bit of a curve. And this might be 0.8, 0.7, 0.6, 0.5, 0. And then this is minus 0.24. And notice the scale is drawn at 12. You probably want to extend your scale up to 0. Because when you try a correlation of minus 1, what you're going to find is that it reverts to a straight line again. It's going to be a straight line hitting to 0 and then back out to 0. That's what you're going to find when you do this exercise. Yes.
What kind of time frame is generally accepted in the industry in terms of historical data to get the same indications of correlation?
This is a purely historical example. As I said, to actually do this in practice, we want to make sure that we've got the best possible projection for the expected returns, for the variances, and for the correlation. Okay, you want to forecast everything before we use this for actual investment.
You can forecast it based on historical data.
You might not use a historical average. You might use something else. For example, what is a forward-looking measure of variance? But here, they've just taken the average of from 1949 to 1976. Just taking an average volatility. What's a more forward-looking measure of variance? Any ideas? The implied volatility from an object. Exactly forward-looking. So I want to use that before I use some average over historical data. Is that based on historical data? Well, not necessarily. It's based on people's assessment of what the volatility is going to be from now to the end of the contract. But this just illustrates what's going to happen when you get this efficient frontier. Okay. Now, I actually go through an exercise where I change the correlation. Yes?
Could you give an example of where the historical would be expected to be significant?
Oil in 1973.
Yeah, or stock market crash in 1987. Massive
You wouldn't know that ahead of time. Somebody was projecting September.
No, just after, like after the fact.
Well, then it would be
And before the fact.
So it's based on historical, I mean, forward-looking is based on historical data. If you have a commodity that doesn't move at all, your forward-looking is going to say, well, it's not going to move at all.
But it might move, that's what I'm saying. That there could be a set of circumstances where it moves. So I'm saying that you would calibrate your model based upon historical data, like I agree, but you're not necessarily going to use a simple average for your forward-looking number. Like I agree, you want to calibrate the data historically.
So in September 1987, were the implied volatility options going up? See, I would think they would have been wrong, so that
they were wrong. Yes.
You would know afterwards, but not before.
Well, it's real interesting because a number of people have studied this. It turns out that if you look at different options like calls and puts, that there was some skewness implied in the option pricing that some people thought was a result of some expectation of a big move down. There's at least some people that argue that you could have seen something in the options. Right?
Okay. Sorry, I think there are other examples though where you're going to have something like that because you know something's going to happen. A couple examples would be right before gold was deregulated. I mean, you knew that there was going to be increased volatility in the price of gold because it was no longer going to be regulated. And I think the same thing was true of interest rates. So, what, late 70s, early 80s?
In 1979, when they moved off the system, the volatility just exploded.
And I think a lot of people knew that there was going to be a change. They might not have known what the change was going to be. But they knew there has to be a change because these things are no longer going to be regulated.
The day after the invasion of Kuwait.
Yeah.
Oil prices haven't had a true chance to move very much, but we know they're going to be more volatile.
Right. Right. And you would not want to use a simple historical average for that. Nor would you necessarily want to use the, this really high volatility for a 5-year horizon. Because your expectation might be that it's a short term, well actually it wasn't clear at the time, but a short term sort of disruption. So don't use historical averages in general if you can do better. Okay. Well, next I want to look at this other graph with different levels of correlation and try to explain it to you. Okay. It's a more complicated graph. There's one correction I need to make on this graph. Where it says correlation of 0, stretch that out and say correlation of -1. That 0 should be -1. Okay, so let me explain this graph. Now we've got this just in general 2 different assets, asset S and asset Q. Okay, so this point right here is 100% invested in S, and this point here is 100% invested in Q. What I'm going to do is to look at various different combinations of S and Q with 3 different assumptions on the correlation. Assumption 1 is perfect positive correlation, correlation of 1. Assumption 2, which is in the blue, is something more like what we saw with the commodity futures, let's say a correlation of -0.24. And assumption number 3, the correlation is -1. Not 0, -1. So let's first take the perfect positive correlation. take a look at it. Now, if you go and plug through the data, like I said with the commodity futures example, change the correlation to 1. You're going to find that all of the portfolios line up on a straight line. Exactly a straight line between Q and S. And notice I've extended with a dashed line up here. And basically what that means is that you're shorting Q to invest more in S. And remember, the weights have to sum to 1. That doesn't mean that the weights need to be between 0 and 1. The example I did with the 6 portfolios, I took them from 0 to 1. But you can take them wherever. So actually, when you change my example, I want you to use, as one combination, let's say, negative 0.4, and then on the other side it's going to be 1.4. The sum of the weights still equals 1. But in this case, you're shorting 1 to get a little extra leverage to invest in the other. In this case, we're shorting Q, and we're investing more in S, and it's going to take us up this direction. And down here, we're shorting S to invest more in Q. Straight line. Now, notice that this takes us off to infinity, I guess, in terms of volatility, whereas this doesn't. Why is that the case? Like, why are we increasing volatility this way but decreasing this way? Maybe. Volatility is right here.
The options in S work more highly than the options would be in Q. Because the S is more volatile, so you're more likely to make a better profit in the options that counteracts the risk.
I understand what you're saying. That given the higher volatility, there could be higher returns on average. But not for sure, and there's no option here on top of that, right? But there could be, like empirically, what you're saying could be correct. But the volatility, what you're saying is exactly right. That the volatility of S is greater than Q. So if you're kind of like shorting, the low volatility asset to invest in the high volatility asset, then you're just going to increase your volatility. That's all that's going on. And down here, you're kind of getting rid of the high volatility asset to invest in the low volatility asset. And at some point, you can actually get your correlation, even though it's perfectly positive, in effect, by shorting, you're kind of changing the sign of the correlation. Like just like when we're doing hedging, right? We match, the 20-year bond that we're thinking of investing in with the 20-year bond in the futures contract. Both of those have very high positive correlation. We need to change that into a negative correlation for our hedging. And how do we do that? We short it. So it's basically the same idea here. So at some point, you're going to get to a 0 portfolio standard deviation and bounce off. And I say here, no negative standard deviations. Impossible, right? Something squared cannot be negative in regular numbers. And we're not interested in an efficient frontier in a complex plane. So that's one of them. So you're going to replicate this. And the one that I basically provided is this blue. And we can also include the shorting of Q. It's going to extend us this way. And the shorting of S is going to extend it this way. So the dots, or the dashes, represent when we're actually doing some shorting. And every single one of these, the weights sum to 1. And the last one is where we've got perfect negative correlation. And that's going to take us to this point Y, which means the portfolio has got 0 variance. Then we're going to go back to Q. Notice we would never invest along this line. We'd always be up here. In terms of the minus 24% correlation, we would never invest down here. In terms of the perfect positive correlation, we would never invest down here. So this is basically, I'm just drawing a graph based upon a different assumption on the correlation. Okay. The last issue on this graph has to do with this thing here, the orange. What's going on there? Suppose that we've got two additional portfolios, U and V. Expected return and variance of U lands right here. Expected return and variance of V lands right there. Question: is it possible to have a frontier that's shaped like this?
That's just another weighting.
We're weighting U and V here. That's it. Is it possible to get that? But you can argue with the yeses. Okay. How is it possible to get something going backwards that way? What does the correlation have to be?
Good.
Greater than 1. Because look at the between S and Q. This is 1, a correlation of 1. This is a correlation of minus 1. And everything else is within this triangle. Everything. We know the correlation goes between minus 1 and 1. So the only way for us to have a frontier that's coming this way is to have a correlation of greater than 1, which is impossible. If you want to try to construct it, that's fine. There's just no way. You're going to fail. There's no way to get better than 100% correlation. Okay, so this orange portion here is not possible. Anybody shows you a frontier with a scallop on it like that, it's clear that there's a mistake in the program they generated. Okay? The worst possible scenario here in terms of diversification is a correlation of 1. The correlation of 1, we would just draw a line between V and U. Straight line. You can never be to the right of the straight line. Okay? So the last thing I want to mention is how to put this all together with a larger set of assets. And all this that I'm scrolling through is just the talk that we just had. With a larger set of assets, you're going to get the same shape. Okay. And you can think of actually doing this with brute force, where, remember I said you had this column with the different weights in it? You can just kind of set it randomly to select weights. Just make sure they all sum to 1. And after you do the portfolio variance and the portfolio expected return, you're going to get a point right there. And let the weights randomize again, you're going to get another point. Just keep on doing many different points until you fill out this thing. It's going to look like a blob of dots. Okay? And then we're going to use our rule of portfolio selection. Of all of the assets that have this standard deviation, pick the portfolio that's got the highest possible expected return. That's going to be right there. And we're also going to use the other rule that says for all the portfolios that have this return, pick the one that's got the lowest variance. That's going to be right here, right here, right here. So by brute force, we're going to get this parabola that's all kind of like filled in with black, representing each dot. that we plot. We're going to pick off those portfolios that are on the edge. It's called the minimum variance frontier. So we know that investors prefer a higher return and a lower variance. So therefore, everything on the negatively sloping portion is going to be eliminated. So what I've got in blue here is the efficient frontier. These are the portfolios, the best possible portfolios that we're going to select. Now, it's not going to be brute force. There's going to be like some mathematics to this where we can actually solve for these portfolios. We're going to do that next time. And not in great rigor, I should warn you, because it's easily done in Excel. Okay? It's just going to be the same thing as a linear program. You did a linear program where you maximize something subject to some constraints. Well, we're going to tell this thing to maximize expected return subject to the constraint that the variance equals this dot here, this level. It's going to pick the portfolio that's got the best expected return. Excel is going to find the weights for us. Okay? And we're going to continue to do that until we draw the whole frontier. So what we're going to do next time is show how to do that. And the last thing that we have to do, and this is very important, the last thing, and I want you to think about this, is so what if we get this blue frontier? And so what if we can use Excel to solve for all of these portfolios? Which portfolio is best for me? So we have to pick a particular portfolio on that blue frontier. And that's going to be called the optimal portfolio. Okay, so we'll pick up on this next week.